in listen-only mode.
Hello, everybody. Welcome to BYSC webinar. This is our fifth series. Today's topic is on how to invest in growth stock. All right. So before we proceed further, I would like to check if you can hear me. So on your webinar, there should be a control panel. If you can hear me clearly, could you please click raise the hand button? If you can hear me clearly, can you please click raise the hand button on the control panel? Okay, I'm scrolling down. I'm seeing a lot of hands now. Okay, great. You can lower your hands. You can put down your hands now. Thank you. I'm sure you can see me on the webcam, right? Yeah, so let me introduce you. My name is Shane. Um, with me is PC Wong, who is a full-time investor and author and who will be sharing on the session today. And I will be the moderator. I want to thank everybody for taking your time to attend our webinar this evening. And today we're going to discuss how you can compound your money through investing in growth stock. As you know, growth stock is a classification of stock that can help you compound your money faster than the other classification. But of course, it comes with a certain set of risks. So today we're going to explore that in greater depth. So this webinar is brought to you by the Bursa Malaysia and managed by us Live Champ. And before we go on, it's very important to talk about disclaimer. So in general, whatever we share on the webinar is for educational purpose only. So in no way that we are giving you any buy or sell signal to a certain stock. And all the company that we explore in the webinar series is for educational purpose, and we don't give you, and Bursa and us don't accept any liability for your investment losses or gain as well. So if you make money on after you learn from us, then you are responsible for that. And if you uh, didn't make any money, and you're also responsible for your own financial well-being, okay? Because we didn't hold your hands to click the buy and sell button. Today is only for educational purpose only. Now, this webinar is brought to you by Bursa, and we have a series of webinar planned for you. Okay, the first topic on REITs, and now we're on the fifth topic on how to invest in growth stock. And in the subsequent month, we have how to invest in cyclical stock, how to invest in a value stock, how to invest in turnaround stock, how to identify a sunset stock, and uncover the myth of oil and gas industry towards the end of the year. So, well, if you have complete all our webinar series, you should be, reasonably good in stock investing. Now, allow me to introduce the speaker. Now, speaker PC graduated from National University of Singapore in 1989, and he has more than 26 years of working experience with several public listed companies. He's also author of two famous books, and he's a full-time investor, author, trainer, have been investing in the international market since 1995. So today he's going to share with you how to invest in growth stock. Now, this webinar consists of two segments. The first, about 60 minutes on the content, and subsequent we allocate about half an hour for question and answer session. So to ensure that we have strong internet connectivity, I would like to switch off my webcam because I would just want to showcase the speaker. So if you allow me to switch off my webcam to ensure that we have a smoother internet connectivity. All right. So, well, PC, over to you now. Let me change present.
Yeah.
Let me give you presenter control. Okay, I've just make you the presenter.
Okay.
They are seeing your screen now.
Okay. First of all, a very good evening, and thank you for tuning in to this segment of BYIC's How to Invest in Growth Stocks. Now, today we'll talk about understanding the characteristic of growth stocks and learn the risks and rewards of investing in growth stocks, and learn how to identify growth stocks and learn the strategies to invest in growth stocks. Now, what are actually growth stocks? Now, a growth stock is a share in a company whose earnings are expected to grow at above average rate relative to the market. This means that it will always outperform the market in general. Okay, and a growth stock usually does not pay a dividend, especially at the initial stage, where the company would use whatever earnings to invest in capital projects or to spearhead developments, especially in the IT sector. Yeah, growth investors choose stocks based on potential for capital gains, not so much on dividend income, and therefore they can be risky. So, what are the characteristics of a growth stock? Now, it must have consistent growth in revenue and profit, albeit during recessionary cycles, which may see both revenue and profit growth being impacted. Okay, outperformance versus its peers in the industry, continued growth in the company's equity to deliver growth in the share price. So by this I mean that the not only will that company be able to deliver revenue and profit that outperform the general market, okay, but you will also see growth in the equity, which is the total net assets. Yeah, okay, you will see that assets also begins to grow. Okay, and valuation. Now, valuation for growth stocks is somewhat very different from other stocks, in a sense that they may exhibit higher PE ratio or share price to the net asset value per share, as investors may invest for the future instead of relying on current earnings and equity level. So, for example, when a company is showing tremendous potential, you will have a lot of investors moving into that kind of trade that it almost becomes a crowded trade, and therefore pushing the price of the share much higher. And because it is a growth stock, the initial earning capacity may not be able to be very high, okay, but it is delivering an earnings that meet consensus, okay. But then, because people are buying forward of that potential, and therefore you have people boosting up the share price, and therefore it will have a higher PE ratio. So that's why sometimes people have the misconception that, well, if any company, if the PE ratio is high, you know, means it is overvalued, and therefore you should not buy. Rather, I think you have to explore the underlying fundamentals of the company, and also to understand the potential of the company, rather than decide generally that the PE ratio being high, and therefore, you know, you should not consider it as a buy, because high growth companies do have that tendency to exhibit a high PE ratio or a share price to net asset value per share, okay, which means the share price is much higher than the underlying net asset value of that company's per share basis. So, for example, if we, you know, like currently in the US, the Nasdaq is moving very, very high. You know, everyone is talking about Tesla. Tesla has not been making a single cent. You know, yes, its share price is, you know, higher than GM, which is earning a profit. Okay, so at $300 US dollars per share, you know, Tesla is, you know, is actually a fantasy kind of pricing, because there's no earnings. They are losing money. They have burned through billions of dollars in the last few years. Okay, but then the share price, you know, had risen from, let's say, $70 a few years ago now to $300 US dollars. So this people are buying, you know, for that forward potential, but then you still need to be mindful that at least, you know, to safeguard yourself, that company should actually have an earnings. For Tesla, they have no earnings. Okay, so that is the extreme case. But if you are looking at a growth stock, it should have some basis of earnings so that that will allow you to lower your risk. Yeah. So, and also a growth stock may have immense potential to grow the market share and in the fastest growing market. So it must have some certain capacity of of that company to really capture a huge market share based on a change maybe in the technology or in the process. Yeah, we will talk about that more later. Okay, and it must have a good management team with clear and committed vision for the company. So very importantly, that management must have a vision for the future of that company, and that is being translated through progressive development, which are announced and being implemented, not so much as having vision but not doing anything. So sometimes management may have tremendous vision, but as long as they don't do anything, that company would still fail. So that's why the management must be tested, okay, in a sense that you are seeing that whatever they announce, they have actually implemented it. And then you will then know that this management team which you can rely, okay, and to further spearhead the growth of a company. So talk about consistent growth. How do we determine whether the growth is consistent or not? Now, most importantly, you need to study your company's historical financials. 3 to 5 years would be enough, okay, with particular attention paid to the last 3 years, okay, because right now, sometimes if you look too far back into the history, at that time, technology have not reached its potential level and so on. So that's why that company, if you look too far back, certain changes could be happening more in the last 3 years than in the last 5 years. So pay attention, especially to the last 3 years. Now they must demonstrate growth in the following areas: revenue, net profit, and equity. Now, revenue growth is a very important indicator, because if you are investing in a startup, okay, company, revenue is even more important, because initially they might not even have a net profit. You may have negative earnings, okay, a loss in the first few years, okay. Therefore, tremendous attention must be paid towards the revenue. But if let's say that company is not exhibiting any earnings, okay, then you need to look at revenue and then debt equity. Now, is the total net assets, okay, declining at a very fast rate, okay? If let's say it's declining at a very fast rate because there's a lot of cash burn, okay, then you need to be very careful, okay? So if the net profit may not happen, okay, then you look at the revenue. Is the growth enough to actually maintain that equity, or there's a slight drop in the equity, rather than tremendous cash burn, and impact upon their current assets, yeah. So the equity would likely to drop. So then would the cash burn be so severe as to make the equity fall to a much more faster rate, okay? So then you need to gauge that in order to determine whether that company is worthwhile to invest or not. Now, all the above factors will influence the share price. But further down the road, okay, assuming revenue growth is there, net profit growth is there, okay, yes, it will help to boost the share price. But if the underlying equity also show growth, then that will reinforce the share price growth much more. Okay, so I'm going to share with you an example. Okay, in this example I use myeg.com.my. Now there are 4 charts here which I want to show to you. Okay, revenue. You can see that in the last, including this year, let's say the 5 years. Okay, you can see that revenue is trending up. Now this is just only for the 9 months period. Now, assuming if we move into the full year, it will likely surpass that of 2016. So this is a company which has exhibit, okay, a huge revenue growth, okay, especially during the period of 2015 to 2016. Then again, you look at the net profit, it is exhibiting a similar trend like the revenue. Again, by the 12-month period, the full year net profit should actually surpass that of 2016. Then let's look at the shareholders' equity. You see there's been a steady increase in the shareholders' equity. Now, very importantly, okay, equity, as long as it can demonstrate growth, not so much as setting a huge target that equity must increase by how much and all those, because always any company that is on a high growth situation would normally reinvest that kind of capital. Okay, so equity, as long as there's growth, then that will further boost the share price. Then you look at the total assets, it has been actually increasing, and you can see that the total assets and shareholders equity, even by the 9 months, it have already surpassed that of 2016. So this company is really on a right track. Okay, so you must you must see in these 4 charts that it has been very consistent uptrend in the 5-year period. Okay, so outperformance versus peers. So how did the revenue, net profit, and equity perform versus peers within the same industry? Okay, if let's say in the absence of any peers in the industry, then you can look at some other company stocks that you are interested in. Would you then you compare, is it better than the other company that you're considering? Is it worthwhile looking at its performance, okay, versus the risk environment? Okay, so but always when you are looking for a growth company, okay, you have to look for signs for positive growth that is above the market norm. Okay, and one particular benchmark you can use is the ROE. Okay, the company should demonstrate superior ROE versus the peers. Now, if you look at myeg.com.my's ROE, you can see that it's 24%, 25%, 27%, 31.7%, 30.2%, and 42.3%. So its ROE is tremendously high versus, you know, I think those of you who followed me a few session back where we talk about the properties, if you can remember that, you know, we were examining several type of property stocks, and the highest one of them, I think the ROE was around 20% or so, or even less than 20%. But you can see that MyEG is 31, 30, and 42%, which means its ROE is very, very superior versus some other stocks. Now, if the ROE is high, okay, it is really returning that kind of earnings, okay, for that kind of investment that you have made. Okay, because some companies may have ROEs that are in the single to the teens kind of thing, but in this case, MyEG is actually far surpass most of those other companies. Yeah. So valuation. Now, valuation is based on potential in future earnings, even if there may be no earnings in the recent financial year or years moving forward. Yeah. So in the absence of earnings, it is important for you to track what the company has done thus far to capture market share and what is its guidance moving forward. So here it goes back again to the revenue as well as the management. Okay, now when there's no earnings, a lot of attention must be paid to the revenue. Is the revenue showing signs of growth? Now, if let's say that company on the let's say first 1 or 2 years, you know, they talk about plans and things, okay, but the following year, the revenue is actually, you know, after 1 or 2 years, it starts to decline, and then the management plans that have been talked in the past few years, you know, has not been implemented. Then these are the signs that that company, okay, could be facing some trouble, and that is when you should really evaluate whether, you know, you should actually cash out from such a company. Because when it comes to growth companies, especially at the initial stage, there will be a lot of capital investment. Some capital investment may be very fruitful, and if, let's say, capital investment that are done is done in where the market is not ready for it yet, let's say, okay, or that idea is too idealistic and less practical, then it can all fall apart as well. So that's why investing in growth companies, especially on the initial stage, is rather high risk. So therefore, it is better that you invest in a high growth company where there are earnings. Of course, if at the initial stage, the kind of multiples that you will enjoy as the company deliver its revenue growth and earnings growth and ROE growth that beats market expectations and also beat the market norm, then your reward will be fantastic. Okay, higher the risk, higher the reward. But if you have identified a company which you think, you know, has that kind of high growth potential, then if you want to be less averse to the risk involved, then you might want to wait for an opportune time where the company finally deliver its earnings, okay, and then you can start to buy into that company. So oftentimes, okay, to be on the safe side, seeing earnings is, of course, will lower your risk. Okay. On the other extreme, if you get in at the initial stage, okay, when the company takes off, your multiples would be much higher. Okay. Now, in the absence of earnings, okay, you can fall back on the balance sheet, okay, which could form a base, okay, to identify the value of the company in the form of total net assets. Yeah. So if there's no earnings, you look at the total equity. Okay, how strong is the company's balance sheet? You can also calculate some of the financial ratios, okay, to determine whether this company meets your KPI or not. Very early into this series of sessions, we have talked about setting KPIs, you know, for different type of industries. So if you have a certain KPI, measure the financial ratios against your KPIs. Okay, so that at least you know that, you know, in the absence of earnings, the balance sheet ratios are still good. Okay, and therefore the risk might be higher, but then at least you know that within a certain period, okay, the current ratio are good, the debt to equity ratio are good, that the company would not be too financially burdened. Okay, and therefore you might want to invest, okay, at that initial stage, right? So if, let's say, when there's earnings, okay, and earnings start to come in, then you also need to look at the total equity to see that, you know, earnings are right now helping to improve the overall equity of that company. Okay, so that you can see further share price appreciation in the future. Now, as I mentioned, the valuation for high growth companies are often very skewed towards on the high side, especially when it comes to the PE ratio or the share price per net asset value per share, because of investors' pursuit of future potential. Now, myag.com.my has a PE ratio of 40.6 and a share price of over the net asset value per share of 15.1 times. So you can see that it's very skewed towards the higher end of valuation, but then it does not mean that that company necessarily mean that that company is overvalued, okay, versus the potential to deliver even greater earnings. Yeah. So again, don't always set a limit that the PE ratio must not be more than X figure. Okay, and if let's say it's more than X figure, therefore you will not invest in that company. Okay, so study is like underlying financials and look for the potential of its growth. Okay. Now, potential to grow market share. The company must have the ability to capture and grow the market share, and is determined by some of the key key things that you need to understand, that you need to understand. For example, possession of cutting-edge technology. Now, sometimes, especially in the biotech sector, okay, a company or even in the IT sector, a company may develop a certain technology, okay, and that technology could change the way that certain tasks are performed, okay, or it can revolutionize, okay, a cure for a disease or something like that. Now, if that company has that kind of technology, okay, then likely, you know, it will be able to capture a very large market share, okay, and you know, it will be able to move away from a lot of competitors. And this is the kind of companies that you should look out for. Now, the other is possession of patents or master license covering a region. Now, some companies, once they develop a certain technology, they will patent for it. If let's say that technology is new, and possession of these patents would then allow the company, you know, to have unrestricted expansion, because once you have patent, okay, competitors could not move into the market until the expiry of the patent, and normally that patent lasts for many long years. Okay, then some would actually have a master license, okay, from the licensing body, okay, the owner of that technology, okay, or the owner of that patent, and therefore they are able to have a master license and able to develop the business using that technology covering a region. Okay, now a region would be a lot more attractive than just a country in this regard. Okay, so the other thing is ability to transform work process to improve efficiency by leaps and bounds. Now, that company may revolutionize the entire work process. Now, which company it comes to mind? In this case, I would use as an example like AirAsia. Okay, previously, when you have to go to a travel agent to buy the ticket. Okay, then you need to go and wait on the queue line, okay, to check in as well as to check in your luggage. Okay, but AirAsia has revolutionized the entire process. Okay, although it does not possess a cutting-edge technology, but is able to transform the entire work process so that they have become very efficient. Okay, there's tremendous savings from the stationery, the printing of tickets and things like that. Okay, able to expand. Okay, that travel right now not only just cover the air ticket, but you can also book online hotel accommodation and such. So these are work-changing processes, okay, that a company can implement. Okay, and then the other thing is management vision and commitment. Whether that management is going to sit on their laurels by just having that cutting-edge technology and then wait for the patent to expire, or that company will continuously look for work processes, okay, or new technology to improve the delivery of their services. Okay, management vision and commitment therefore is very important. And how you judge a management vision and commitment is by seeing how the management perform. And one of the best gauge is actually the financials. Yeah, you can see if let's say the management wants to, when the management says they want to grow market share, okay, now that is then translated into the revenue. Okay, when the management says that they want to have reward the shareholders. Okay, then you look at in terms of what kind of reward have they given to the shareholders. Okay, then the management vision of expanding the business, what steps have they implemented. Okay, so when the management, you know, they make announcement, they will do this, and eventually, okay, is followed through with a confirmation that this has been implemented, and this process of this new technology then will contribute how much to the overall revenue. Okay, all this will be announced, you know. But if a management give a vision, okay, or they say they plan to acquire this, okay, they make announcement they want to acquire this business, or they make announcement that that they want to grow this market share, okay, by how many %. Then later, by the next few quarters, you know, if the management announced, or the deal did not fall through because of the deal did not went through because did not go through because various parties are unable to reach a conclusion, okay, or agreement, okay, or when they say they capture the market share, then they say that we are unable to capture the market share because of competitors, you know, all this. So the moment that the management give all sorts of excuses, okay, versus what were their plans and vision, okay, and that they have announced previously, then this goes to show that the management, you know, is trying to bluff their way through, you know, to boost up the share price, but every time it winds up with nothing concrete. Okay, so when a management is giving this kind of false hope, okay, then it's when you must be really concerned about such a company, because it seems that the management is more, is on that fantasy land level, and not on the practical kind of level where they are able to deliver results. So sometimes people say that, you know, yeah, you know, talk about knowing the management and such, you know, but then, you know, I don't know them. How do I know? Well, you look at the financial performance. That's the most important gauge. The other is whatever announcement that they make, are they committed to seeing that announcement go through? Okay, and you know, it's not just talk, you know, and then come up with excuses why it didn't go through, you know, or they give indications that, you know, competitors, things like that. But if let's say they possess that kind of work process that will change the industry, then you shouldn't be talking about competitors. Yeah, right. So that's why you have to be very careful about what the management says, okay, and test their level of commitment to what they say, you know, by looking through all these kind of things. That is how you understand the management. Yeah. Okay, so just now we touched on the management. Then some further things that you need to know are who are the people behind the company. Okay, especially if the company is technology related, what are the credentials of the people involved in developing that technology? For example, if that company, you know, is very web-based, okay, it's IT-based, who are the people behind that technology? Is there a chief technology CTO, chief technology officer? Okay, who are the developers? Okay, what are their credentials? And if let's say they are from the biotechnology, it's a biotech company, okay, what are the credentials of the people? Are they a PhD? You know, what doctorate do they hold? Are they into viral medicine? You know, things like that. These kind of credentials are very important, especially when it's technology related. Yeah. Okay. So always you can look at that credentials, and that will actually reinforce your confidence in that company. Then again, also the years of experience, key personnel in the management in specific field, and proven ability to grow a business. Okay, so sometimes one of the key investor, okay, could be an outsider, okay, but he has okay, he has managed to, he or she has grown a business that is already very well known. Okay, that could be a person who is backing that company. Sometimes this would add credence to that company, okay, because you have someone that is well known, okay, as a financial backer or as an investor in the early stage, okay. So that's why sometimes companies that are IPO or IPO or during the course, they will actually include certain directors who actually have very strong reputation. So all this serve to reinforce the credence of the company, okay, and give stability to a company because they have someone very experienced in the business world joining them and so forth. Yeah. So risk of investing in growth stocks. Now, when a company is not yet able to deliver earnings, that's when the risk is at its highest, okay? Because there could be revenue growth, okay? But then to sustain that kind of revenue growth, that company, okay, is actually burning cash, okay? Now, using an example like Amazon, okay, Amazon is worth let's say more than $1,000 per share, but Amazon profit margin is so low and it burns a lot of cash to continue sustaining that company. Then you look at Netflix, okay, these are the companies that burn a lot of cash just to deliver a very small amount of earnings, okay. So when this kind of things happen, okay, it puts the risk at a very high level. For example, okay, if let's say there's a company that momentum players are chasing that stock, and this growth company, okay, seeing its share price go up even higher, okay, will you be part of that momentum chasers? Okay, so not knowing when the momentum would actually stop and therefore crash, the stock would crash, okay. So that's why always have something to fall back on. It doesn't mean that if let's say, okay, if let's say that the cash burn continues, okay, there is something that is showing a red flag, and you should be a bit more cautious, especially if let's say this company so-called is a high growth company, you know, but in their 5 to 7 years of existence, they have been continuously burning cash and deliver only a very small amount of earnings, okay, although revenue may be very, very good. Now then you have to be a bit concerned, okay. Sometimes I would rather not be a momentum chaser, okay. I don't mind partaking in some risk, okay, when that company is showing some promise. But as soon as I see, let's say, you know, the cash burn, you know, is getting a bit ridiculous, okay, and then although there's revenue growth, but then the earnings sometimes is inconsistent. Sometimes they are loss, sometimes they are positive earnings, sometimes they are is negative. Then it's something very troubling about this company. So as I mentioned earlier, a growth company must exhibit consistent growth. The keyword is consistent. If let's say the company is inconsistent in delivering earnings, okay, then that is something you should exercise some caution, and then really be able to, you must really be able to understand the risk before investing. Okay, now always know that when there is unless there's specific things like cutting edge technology and it's patented, which then for a fixed period of time competitors cannot use similar technology, then that company would have would be able to spearhead its growth over a longer period of time, and therefore it becomes very lucrative. Now, but if let's say it's a lucrative market, but it does, that company, you know, it's just only changing processes, okay, it's just only changing processes, it doesn't possess any patent, okay, or cutting edge technology which is wholly owned by themselves, okay, then you will see a lot of people entering into the industry, okay, because it's a process that they could be copied, okay. Now, just as an example, Groupon came up with discount vouchers, and then when it was listed, the share price really blast off. Then, you know, but there's no cutting edge technology. You are just selling coupons. So eventually, you know, it's so easy to start up an internet company and then start selling coupons. Okay, and then Groupon also, you know, gone case already. Okay, because it's that process could be duplicated. Now, similarly, okay, like let's say AirAsia, okay, they started off revolutionizing the work process, but then soon all the airlines also do the same, okay, and therefore that process then is easily duplicated, okay. So that is when if that process, okay, you may have a head start, but then competitors will enter it, okay, and therefore it will impact upon the company's future earnings, okay, because if let's say it's a process, it can be copied, because it can be copied, okay, because it is something that you do not hold patent against, right? So these are the risks, okay. So you must clearly define, you know, set your own definition of how you want your ideal growth stock to be, okay. So then this kind of definition, then becomes like your KPI. For example, you have a checklist, okay, must deliver revenue growth, must have earnings growth, must have ROE growth, okay. Then when you do your own analysis of that company, you know, there's this kind of checklist which you can take, and then you realize that, hey, this company meet, you know, 80% or 75 to 80% of my checklist, then it's something that I know that my risk would be lowered, and therefore then I may decide to invest into it, okay. Not just by reading, okay, that this company is able to do this, okay, and then immediately you think that, hey, you know, I'm going to buy this company because the management says so, okay. So it is better if, let's say, you have, because of the prevailing risk, yeah, that if you invest in the wrong growth company, then you can get that label. So that is important, that at least you have some definition of what your ideal growth company should be, okay. Then you have a checklist, okay, whether you meet this kind of specifics in your definition, yeah. Now, the rewards of investing in growth stocks, of course, there's always the first mover advantage, okay. If the company possesses new technology, patent, or owns a master license, okay, in the early years of growth, okay, although it could be challenging, but as it gains traction, its appeal will gain support among investors, okay. So having that kind of technology, patent, owns a master license, okay, will actually enable that company to move ahead away from the competitors, okay. But in doing so, in the early years, okay, that company could have very challenging situation, yeah, to deliver consistent earning growth, okay. But once it's able to do so, okay, and in the absence of competitors, okay, then you will see that a lot of investors would then warm up to the company, and then they would actually invest in the company, and therefore, you know, it will be able to gain the confidence of a lot of investors. Now, further growth and rapid expansion could elevate the company to key benchmark, increasing the share liquidity and investability, delivering both dividend and share price gain. So normally, what I'll be looking at, okay, is a company that if let's say it is consistent growth, okay, it doesn't mean that it grows by, okay, a small percentage, okay. I'm looking at something that is quite parabolic, okay, and this is what I mean. So let's look at example. Go back to myeg.com.my. How did the company fare? Now, according to the STAR dated 30 February 2017, an investor who held onto the stock over the last 5 years would be 15 times richer at its current price of $1.63. Now, based on this analysis, which was done on 22nd of June, it was priced at $2.11. So how many times richer would that investor be? Okay, so from $2.11, you minus that out, okay, which means every share actually gain another 50 cents. So that essentially means that, okay, those who invested 5 years as of 22nd of June, could be about 18 times richer. But if let's say at the initial stage, how much richer would that be? Now this from Google Finance, yeah.
If
Okay.
if you buy 5 years ago at 10 cent, today closing price is 2 ringgit 15 cent, you are 21 times richer. 5 years ago.
So
right?
if
5 years,
so if you
flip 21 times.
yeah, this one is actually adjusted because during the years they actually have a lot of rights issue they have rights issue they have rights issue, bonus issue, you know, and so forth. And this one, okay, you look at it, this Google adjusted, yeah. Google Finance actually adjusted since its inception. Actually, the company started in 2005, but looking back the last 10 years, okay, now its share price was actually 8 cents, adjusted for all the splits, bonus share, and so on. Yeah, it's 8 cents, okay, and it's at 2 ringgit and 11 cents. So can you see how many multiples that is? That's easily about 27 or 26 times already, you know. If you just hold it for 10 years, if 26 times just over 10 years, it's like every year on an average, you know, the share price, you know, doubles. Okay, so that's why, but of course, at this initial stage, you can see that. Okay, in this initial stage, you can see that there's hardly any dividend. Okay, the company started much earlier in 2005. I think during that period also was pretty challenging, yeah. But then once it stabilized, yeah, its dividend becomes more steady. Okay, and this is what I mean by a parabolic growth. Okay, you see that it moved up quite fast from 2013 onwards. So parabolic doesn't mean it shoot up straight now, that is vertical, okay, but parabolic is something that you can see a trend that is ascending very fast. Okay, so this is something to look out for. Okay, so in case anyone asks, shall I buy MyEG, you know, right now? So I will not say anything, but please do your own financials study, okay, and determine whether this company meet the kind of definition you have set for yourself, and whether you meet the kind of KPIs that you set for yourself. Okay, because everyone has different risk assessment. Okay, so if you look at it, these are the kind of trend that you should look out for. Yeah. So strategies in investing in a growth stock. First and foremost, understand the company and what it does. Will the company be able to change a process or own a patent which allows it to capture market share? Now, AirAsia, for example, is able to change the process of flight booking. Okay. However, it is not able to sustain consistent earnings due to the capital-intensive nature of its business and primary reliance on a commodity for its business to function. Okay. So AirAsia, yes, they changed the entire process. Okay, but then in order to grow its business, it needs to lease aircraft, it needs to buy aircraft, which are all very capital intensive. In order to buy, you need to incur financing costs, okay, or you need to issue new shares, okay, which then, okay, would impact due to share dilution, okay, and it also need to rely on the price of oil, whether it's favorable to its business, and therefore to hedge accordingly. Not forgetting, I think there was 1 year which AirAsia hedged wrongly, and they lost, I think, quite substantial tens of millions, if I'm not wrong, yeah, because they hedged oil on the high end, okay, but then oil price dropped, okay, to 40, 60 US dollar per barrel, but then they hedge it on the higher end, okay. So then, you know, these are the risks of that business, okay. So good work process, okay, but then it's a process that can be duplicated by competitors, okay. You need to have it is capital intensive because you need to finance your aircraft purchase, okay, and it also rely on the fluctuation of crude oil, okay, which can hamper or provide benefit to that business. But then it needs to rely on a commodity, and commodity, as far as we know, has its ups and downs, okay, and because of this up and downs, companies need to hedge. But if you hedge on the wrong side, okay, then it could be very unprofitable venture, and the company could suffer some heavy losses. Okay, now then you look at myeg.com.my. Okay, it provides solutions with recurring income stream and does not rely on a commodity for its business to function. Its business model is also non-capital intensive. How capital intensive it is to set up websites? If you go to myeg.com.my, you can look at all the payment gateway and all the kind of websites that they are providing solutions for people to make booking, to pay this, pay that. Okay, so then it's non-capital intensive. Okay, there's no, you no need to each website you no need to refinance or to start up a website, because it's very simple. They have web developers, it's so easy to develop a website. Okay, and you have the kind of system that you can just, it's like a modular system. You just set up, and this one start earning, that one start earning. It's all recurring income. Okay, and there's no reliance on any commodity. Okay, and that is why MyEG is able to be very profitable. Okay, because they have changed the way people manage their insurance. Okay, manage their payment to various agencies and so on. So they have managed to provide that kind of solution. Okay, but of course, on the other hand, when MyEG started off, they actually have a lot of support. Okay, in the sense that they created that environment where a lot of payment to various agencies could be made. Okay, but right now MyEG is moving further ahead. They are no longer reliant on just payment to government agencies. They are starting their own multiple types of websites and payment gateways, and also other solutions. Okay, to help the company grow much further. Okay, so you can already see the difference. Yeah. Okay, both also are very process orientated. Okay, but both also can be duplicated. Okay, but then one has able to move ahead simply because it's very low cost. Okay, and it doesn't rely on a commodity. So always, one of the key things that you should look at, if let's say a company, okay, that profess that their growth is going to be fantastic in the future, okay, they might even term themselves as high growth. First thing you need to check, are they relying on any underlying commodity or not? Okay, for example, in terms of iron, okay, in terms of lithium. So for example, some companies, they say that well, we are in the process of doing battery, okay, lithium batteries and so on, because that is the future. In the future, there's just going to be lithium batteries, okay, and fossil fuel will actually be in decline, and there'll be tremendous demand for our lithium battery. Yes, it could have that kind of underlying nature of a growth company, but what if lithium is still a commodity? What if, due to various expansion, okay, and suddenly the price of lithium shoot up? How long is that company able to maintain its growth when the cost of a primary product that it needs for its production shoots up? So if they're going to pass the cost to the consumer, how would the consumer react? So that's why sometimes even a company with high growth potential, Okay, always remember, there are good times, there are bad times. Most importantly is how to make money during the good times and cash out before the bad times. Okay, so that is why always need to monitor. It doesn't mean that a high growth company, will continue perpetually, going up and up and up. So there are times when certain things or situation change, a company may be affected. So invest wisely, okay? Look out for the potential, but always know that, as long as that company relies on commodity, you will know that at some point in time, okay, it will be able to meet its Waterloo, okay? Now, the other thing is look for consistent growth in several key metrics over a period of 3 to 5 years using the following benchmark. Now, these are the benchmark that I normally set for myself, okay? It doesn't mean you have to follow, okay? But you can set your own requirement. Revenue growth 15%, okay? If you want to be more aggressive so that you really take the very best of the pig, you can say revenue growth must be more than 20%. Okay, but for me, I set up 15% because of the global economy. Okay, that is sometimes it's good, sometimes it's bad. Normally, currently, I set for normal stocks, I just set a revenue growth of 5% as my KPI. But therefore, 15% to me is something that is above the norm. Okay, net profit growth must be more than 20%. Okay, equity growth positive. No need to look so much as 20-30% or so forth, okay, but as long as positive, because a company may be, okay, the equity growth may be affected when a company do a lot of capital reinvestment, okay, and some of it could be involve borrowings, okay, and therefore borrowings are actually liabilities which could actually lower down the equity. So that's why do not set too much rigid. As long as, for me, as long as the top line and bottom line looks good, equity growth is positive, I'm quite fine with that. But then you can also set that minimum maybe 5%, okay, or 10%. It's up to you. But I'm using my own set of KPIs here. You can change the KPIs. You need not necessarily follow mine, okay, because our risk assessment always differs. Then an ROE must be more than 15%, okay. Now, if you are investing at the startup stage, it is important that the company have strong balance sheet because there will be cash burn initially. Measure the financial ratios to determine balance sheet strength, okay. Don't just look at the potential, but that company, especially at the initial stage, must have the kind of financial ratios and financial strength that will enable that company to last long, okay, moving forward, rather than after 2 quarters the company announced we are going to issue new shares, and then further dilution, then the share price will drop, okay. Then another 2 quarters the company say in view of the kind of strategy, we are going to borrow another 100 million. Wow, then it will actually impact upon the financial strength of a company, okay. So that's why look at that kind of financial ratios to determine the strength of that company financially, strong enough to move forward without incurring dilution, without borrowing more, okay, to finance its expansion, okay. And the last thing, if you are investing in growth companies, especially at the startup stage, have patience, okay. If you can go back at this chart, okay, you can see that for the greater part of those years, okay, what that kept the investors going perhaps were the dividend, okay. But once the company really takes off. But then if you are investing somewhere around here, once there are substantial earnings here, you're also not too bad off. So that's why it depends on your risk assessment, okay. So if you want to go at this startup stage, okay, the risks are much higher. There will be cash burn, there will be worries that you are concerned with, and so on. But as long as the company financial ratios look sound, okay, it's not over borrowing, its debt level is not too high, then maybe you can hold on for a longer period and see the end result much later on. Or if you want to lower the risk. Okay, you look for opportunities that substantial growth in earnings, which is somewhere along here. Okay, just now we see that very early on. Yeah, 2013 to 2014. If you have invested here 2013 to 2014, okay, it is somewhere around, maybe adjusted, maybe about 50 cents, 40 cents. It is not too bad, you're still able to get 5 to 6 times. Okay, so that's why, of course, on the lower end, high risk, okay, higher rewards. If you want to play safe, then you're not too bad either. Okay, you're still able to be several multiples earnings, your profit gain. Okay, so that's why you need to have patience. Okay, and not to expect immediate result. You have to see and wait for the company to grow. Okay, if you like a particular company but you want to wait until earnings, then just monitor that company, okay, until you find that yes, it has met most of your definition of a growth stock. Then you can actually make your investment into that company. Yeah, that's all I have. Now we come to the question and answer session.
Okay, thank you, PC. Now we are coming to the Q&A sessions. Now, if you have any questions, you can write down in the questions box, and then we will address it in a short while. Is IPO stock considered a growth stock?
Not all IPOs are considered a growth stock. How to identify a growth stock? You need to look at what type of business are they doing. For example, as I mentioned, if let's say that in the IPO process, the company lists that it possesses a master license covering a large area, a regional or region, okay, or it has certain technology and their technology is patented, then during the IPO, then I would consider this company as having the potential to be a growth stock. But if let's say that company or as a private company, it has already been making waves, yeah, especially in the technology sector and so on. And when they are announcing IPO, yes, then I would see that as a potential as well. But not all IPOs should be considered as a growth stock because it depends on the nature of their business. Yeah.
Okay, so good question, good answer. So next is, where can I get a list of companies that are just listed through IPO or have been listed for a specific time period, for example, 2 years? Is there a website to filter?
I think you can always refer it to the Bursa
Malaysia.
Bursa Malaysia. I think that's the marketplace.
If you go to bursamalaysia.com, you can see which are the newly listed companies. Yeah. So on average, 1 year there will be about 10 to 15 companies listed. So you go to bursamalaysia.com, you can find the new IPO companies. Yeah. So sorry, I have you answer the question already.
Yeah.
Yeah.
Okay.
So the next question somebody asks is, what is your opinion on earning yield for calculation for growth stock? Is there any tool for plotting earnings yield graph?
I think if you want to look at earnings, okay, look at the kind of consistent growth, okay. It must have something that is in the double digit, okay. As I mentioned, I'm looking at earnings growth of, let's say, at least 20%, okay. So these are the things that you can plot, but try not to be too rigid that if let's say you already invested in a stock and suddenly the economic downturn and that stock falls, that you want to sell, okay. So if let's say the company have been very consistent, even if the earnings fall, okay, during hard times and the share price really actually falls quite substantially, then you might want to then buy in to bring your to average down, as long as that company, you know, have that kind of potential remains. Okay, do not be too consistent. Do not try not to be too stubborn that it must always meet this kind of benchmark. Yeah.
Okay, I see. Now, for those of you who don't know what is earning yield is the inverted PE. You use earning divided by the price. Okay. So, next question is, how do I buy IPO stock?
You can actually ATM. Sometimes I think you can also do that if I'm not wrong. Yeah. They will also be announced. Okay, Bursa will have announcement. Then also Bursa also have announcement, and then I think newspaper also they will have announcement in the media. If the IPO is everywhere, yeah.
Okay. So, in your experience over years, which financial ratio is best used for growth stock that grow multiple folds?
I always look back at two things. One is the current ratio, the other is the debt to equity ratio. Because one is more on the current one, which means how the company, current means anything that's within the 12-year, how within the 12-year period, I mean 12 months period, sorry. The current is for the 12-month period, how that company would fare in the 12-month period. If let's say its current ratio is strong, then at least I know that within the next 1 year, that company should be quite okay, right? But then on the longer term basis, for me to gauge the financial strength of a company in the event of any shocks, then I will look at the debt to equity ratio. If let's say the debt to equity ratio is weak, but current ratio is high, then I would be a bit concerned as well, okay? Because that could mean that company is over leveraged. And if let's say there's financial shocks in the 18 to 2-year period, that company could be quite worse off than its current position. So use that tool to gauge.
Okay. Now the next question is on MyEG. So they're asking that MyEG depends heavily on government contract. Would it be too risky for investors?
I think first and foremost, MyEG has moved quite far away from that already. If you go to its list of websites here, they are doing all sorts of websites that are involved in, let's say, travel, not so much as just paying to the agent. Of course, monopoly of that give them that edge, but then you can see that they are reinvesting it into other sectors that is non-government related. I think I read a report that a very big percentage right now is not depending on government contracts anymore.
Okay, awesome. I think recently they also roll out this EIS. I'm not sure whether you heard about it. Like the EIS is another dongle system that would require about 6 industry to avoid them not paying the GST, to make some retail industry compliant to the GST. So I don't know whether that would boost the share price or not. Yeah, but anyway, the next question is, what is the difference between a growth stock and a normal stock? So he said that he's a newbie in stock investment.
I think if let's say you're looking at, as we have covered earlier, it must have an outperformance. Okay, for example, if let's say ordinary company return on equity, maybe let's say single digit or in the teens. Okay, for a high growth, it could be 20% or more. Okay, like in MyEG, it is 30%. All right.
Okay, next question is how to calculate when to take profit for growth stock, like how to justify whether it's overvalued.
I think it depends on your level of risk taking, because for some people, if that stock have reached in terms of multiples, maybe 2 or 3 times, they could be exiting so that they can actually use their cash for other types of investment. Now, for people who wants to hold on longer, then you need to continue to monitor the company. Like every quarter when you read the report, if let's say that quarter was the current quarter versus the last quarter, there's an increase, okay, in sales, okay, or increase in revenue, all versus the last year's same quarter, year on year, okay, you see that's greater you see that there's greater increase, okay, then you might want to hold on to the company longer. So it is by monitoring the quarterly performance, or that each time you see that is actually improving much better than the previous, then it gives you confidence to hold the stock for another few months and see how is it. Okay, then that is how you get to gain that kind of multiples. Okay, rather than just buy and then wait for it to go up. You must monitor you must read the quarterly reports. If let's say the increase is substantial, then you will immediately decide I will hold it for another 3 to 6 months. Yeah, that's when, you know, from holding for a short-term view of 1 year, it becomes 3 years, then 5 years, and then when you cash out, there's tremendous multiples. But if you just buy and then you don't study the report, then you could open yourself to a lot of risk taking as well.
Okay, so the next question is asking you about sector. Which sector or stock is more potential for the current market now?
I think look at things that are constantly in demand. Okay, consumer maybe. Okay, because consumer goods that forever people will have that demand of that consumer product. Okay, then you look at companies that do not rely on high capital investment. Okay, because any high capital investment right now can be a bit more risky because of the global economy and rising interest rates that could happen. And because if let's say it's capital intensive, most likely it has to be financed. And if let's say when it's financed, then borrowing costs could increase. Look for those that with recurring income stream. Okay, you know, I think I will look at that kind of consumer and those that have recurring income stream but very little capital investment, because the next cycle, those with heavy capital investments could be quite badly affected.
Okay, so how do you predict future earnings of growth stock? This is the next question.
It is based on sometimes on the well, as long as that company, based on the financials, they are able to deliver. Okay, although it's in the history, but then it gives me a trend which I know that, hey, they have been consistently doing this for the past few quarters, then I will actually wait for another quarter. The other thing is that what the management announced. Are there certain plans? For example, management say we are going to roll a new application, okay, and this one will actually target certain specific consumers, okay, in the IT in an IT platform. Then of course, whatever the management announced, then I know that, hey, I will hold on and look at what the future will bring. Okay, look out for company announcement. Okay, as long as you are invested in a stock, you should look at company announcement. You should look at the quarterly report. That helps you. Those will help you decide whether what the potential lies in the future.
Okay, good answer. So to determine consistent growth, should we analyze the company financial based on quarter-on-quarter basis or year-on-year basis?
Quarter-on-quarter basis may be a bit of a tough call, because some companies may have. I normally look at year-on-year rather than quarter-on-quarter basis, because some companies during the start of the year, okay, may have a soft patch, but later half of the year they might be on a very strong trend, because some are cyclical, okay, some are based on the amount of sales done, but then they have certain credit terms, okay, that would actually change the kind of not credit terms. Sometimes they have certain kind of like development, okay, property development. You know, the project may kickstart, but then, you know, the earnings only come later. Okay, these are the kind of things that you should look out for. So it's best to to have year on year, because quarter and quarter sometimes looks hopeful, but then the earning may not be translated until a later part. So quarter and quarter is not something I would favor, but it's also something that which you to just study it just for understanding, not to use it as a basis too strongly.
Okay, yeah. You're talking about seasonality effect, lah.
Yes, yes.
Yeah. So next question is, in your opinion, do you find growth stock in cyclical industry they are currently in favor, or should we find growth stock in non-cyclical sector?
I think those in the cyclical sectors sometimes could be inconsistent due to like those that are related to commodities, okay, can be very inconsistent. So in my own terms, okay, I will look at things that have consistent recurring income as a very strong basis, okay. Those that in cycles, what if, let's say, you know, there's an up cycle and there's a down cycle, then after that there's no more, the next down cycle, then it wouldn't have consistent earnings in that sense. So always look for those that are non-cyclical and have recurring income streams.
Yeah, so you prefer non-cyclical sector for growth. So are there any other reliable sources to keep track on company and economy performance besides Bursa Malaysia? This is the next question.
If you want to look at it, you can study those like when they say when US and China sneeze, the whole global economy will have shock. So you can at least read what is happening in China, okay, what is happening in the US, because normally if the US market is up, the following day most of the markets around the world is also up. Okay, these are the kind of things that you can use as a gauge. Okay, but like in the US, the Federal Reserve is going to tighten. Okay, which means they are going to increase interest rate. Okay, and if let's say increase interest rate, then it will actually snowball to other regions. Okay, where they might also increase interest rate, because otherwise, if the US increase interest rate, US dollar people may have flight of safety into US dollar, and therefore the currency of that country may fall versus the US dollar. So then the local central bank might also increase interest rate, so that at least there's no flight of capital to US dollar. So these are the kind of things that are likely to transit. Okay, once the US implements certain things, or China implements, like for example, China bans its citizens from using its money to invest in real estate overseas, and you can see that in Canada, the real estate has already burst. In Australia, it's already burst. Okay, in UK already bursting. In Europe, Spain, Portugal. Okay, all these which have all the Chinese, you know, from mainland China moving their money into all these, all are bursting already. So that's why this kind of things can impact. Okay, for example, just now someone brought up the question about the UK properties. Yeah, you know, it's bursting. You know, the property price are collapsing. So that's why when whatever happens that in these two countries, you can read about. Okay, and then that may help you to have a better understanding what is soon to be coming.
Okay. So the next question is, there are so many public listed companies. How do you screen and identify good fundamental stocks to do further research?
Well, first and foremost, for me, I adopt a top-down process. So first question I ask myself is, which economy would tend to thrive? Okay, I tend to look at what is going to happen in the future rather than what is happening now. Okay, for example, if let's say I know that the stock market right now all over the world is very frothy. Okay, they are very highly valued, and like in the US historically, you know, the PE ratio now is almost the second highest ever on record. So there's a potential that things might crash. So I would then look at, in such a scenario, what I want then would be more defensive. Okay, I want stocks that are that at least, you know, that's dividend paying. Okay, with good dividend yield, so that if there's a crash, okay, I can then do average down to increase my yield even more. You know, so these are the that as long as I stay invested, I still have dividends. So these are the things that you then look at. What are the dividend stock, okay, that meet your kind of investment. Then you look at, you know, which stock give you the highest dividend, and then from there you look at which one would meet the kind of financial ratios that you set. So this is, for example, what a top-down analysis that I adopted.
Okay, so what do you think about using earning per share to determine growth stock versus the return on equity?
Although earning per share sometimes is mainly used, but like I said previously, that if a company buy back a lot of its shares, okay, its earning per share will show higher growth, even though the profit growth may be lesser. So that's why I prefer net profit growth on an overall basis rather than earning per share. Because as long as a company buys back a lot of its shares, its earning per share can be very much higher, but it doesn't really show the real effect. So I prefer to look at total net profit versus EPS.
Okay, so how do you determine whether a growth stock has become matured?
When such time that its earnings start to go back into the like, okay, let's say my EG right now is you know, it's 20 over percent, you know, consistently. But at some point in time, okay, unless there's an economic crisis, then we you know, definitely it will fall. But let's say that trend outside of an economic crisis, after that 20 over percent, you know, it starts to slow down to, you know, a little bit more than 10%, you know. So if consecutively it shows year on year of slightly more than 10%, yeah, then I know that from 20 to 10 means that it could be reaching a maturity in earnings already. Unless that company acquire new companies, okay, to boost itself, but otherwise it's showing that organic growth is actually falling. You know, then that is a time that maybe I think that it has reached a certain level of maturity.
I see. So this is another good question. So have you come across any good books or study materials to learn about growth stock or value growth? Do you measure as well management, corporate governance indicator such as director compensation, capex strategy in growth stock?
Directors compensation and such, I don't really look at it at every stock, okay? But if let's say a company has good revenue, but then its earnings doesn't reflect that, then of course the next thing I would look at is to skim through all the expenses, okay? If let's say the expenses, okay, goes into payroll, okay, or directors' fees and all those things, which is very substantial, then of course I'll be a bit worried, okay. But sometimes, you know, directors are rewarded for their performance, okay. If let's say revenue is good, okay, earnings is good, I don't mind if directors get paid well, and also, you see, so does the management staff and all those. So you again shouldn't be too concerned. But if let's say if the revenue is good but net profit is low, then you need to really skim through what are the contributors. Yeah. So of course, in terms of corporate governance, if a company has incidents, okay, where it's fined by Bursa for certain non-disclosure or failure to disclosure or late disclosure, then, you know, that will serve me a red flag, is that the management, okay, is not 100% abide by the Securities Commission, the SEC guidelines. Then it's something of a concern. In that sense, I would rate the corporate governance as weak. Yeah.
Okay, how about the earlier question, like what books or learning materials that is
Uh,
good for learning growth investing?
I think there are a lot of books out there, but I started reading. Uh, Nowadays, I don't really read. I just read current news and all those current news and market trends. Okay, based on the internet. But previously, I do read about some of Warren Buffett's investments. Okay, I read about I think quite a very old book. I bought it way back in the 1990s.
Okay.
I think it was Ben Graham's lah. Okay,
Oh,
but
that book
after that
is kind of dry one. His book.
yeah.
Yeah,
I
but
halfway through I already threw it because I understand the principles,
yeah, yeah.
But yeah,
If you
so
ask
there's a
me,
lot of books which just yeah.
if you ask me about books, if I may answer,
Sure,
I
sure.
would say growth investing. What books benefit me the most is Peter Lynch books, which are the One Up, the Wall Street, One Up the Street, and Beating the Street. I think these books talk about growth investing in great depth, and one book is more on application, one book is more on theory. So you can get those two books and read more about growth investing. To me, Peter Lynch is really a good growth investor. Yeah. So anyway, 10 over o'clock. So I we allowed two more questions. There are still a lot of questions on my list, so I will just pick questions that are really good. So the next question is: if a company's corporate structure shows quite a number of subsidiaries and associate companies in foreign country, will it affect the growth of a company?
Um, Sometimes you need to look at whether having subsidiaries are those active subsidiaries. So when it comes to the financial statement, there will be certain disclosure about income earned from overseas or income from shared venture and things like that. So if you have that, okay, then you need to go further down before the comprehensive income for the year. There'll be some adjustment. You look up for any forex loss or forex gain. Okay, that is when you will have a better understanding of that company, because sometimes company may list a lot of subsidiaries here, but are they really active, or are they there for the sole purpose of doing a small business? If let's say it's a small business, it is inconsequential. But then look at the financial reports where they will actually disclose income from shared ventures overseas or whatsoever, and then further down, as long as there's forex loss or forex gain, then you know that that company has substantial business overseas. Yeah.
Okay. So next question is: what is the difference between impairment loss and write-off?
Okay, impairment loss may be something that, for example, an inventory. Okay, you hold a lot of inventory, but due to some reason, let's say iron ore, a particular company owns a lot of iron ore, based on the price that they bought, let's say $3 per pound, okay, $3 per pound. But then iron ore price fell, okay, and then instead of $3 right now it's worth $1.50. So a company may revalue its inventory, okay, and then charge it off as an impairment charge. Okay, now a write-off is when that for example you cannot even recover a single cent. That is when the whole sum has to be written off and it's never recovered. Okay, so that's the difference. Okay.
Okay, we're going to do the last question. Last question. So, can a value stock be a growth stock as well, and also vice versa?
I think if let's a high growth stock can be a value stock, okay, but a value stock whether can be a high growth stock depends on certain things. For example, a company that all the while has been very consistent, but not to the high growth level, but they suddenly acquire a company that has high growth potential. Yes, then it can happen. Okay, but left by itself, if let's say a company is high growth, okay, eventually there come a time where, like I say, its earnings may not reflect that, but then its dividend is reflecting good growth in dividend, okay, rather than you know, just depending on the just having, let's say, 40% growth in terms of revenue and profit, but then is parking back the money to the dividend holders, then that high growth will become a value stock. Okay, that's the way I see it.
I see. All right. Yeah, we have come to the end of question and answer sessions. Yeah, thank you very much, PC, for your in-depth answer to some of the very good questions that they ask. So another question is, how can we support you further? So of course, we also have our next webinar. So this is how we can make you a better investor. So next webinar, we'll talk about how to invest in cyclical stock. Okay. So as the word suggests, cyclical, the root word is cycle. So next topic, we're going to discuss how do we invest in stocks that exhibit cyclical nature. So the date is 1st August 2017, Tuesday. Time is 8:30 to 10 o'clock. So you can register through this link. Yeah, let me paste the link to you. Just give me a minute. Yeah. So here are the link. So yeah, I've just sent you the link in over the chat. So if you want to learn about how to invest in growth stock, join our next webinar. Yeah, with that, I want to thank everybody for your precious time to learn about how to invest in growth stock with us. So thank you, everybody, and I wish you a great rest of the day. Thank you and goodbye.
Yeah, thank you, and
Yeah.
thanks for tuning in. Good night.
Yeah, good night.